How banks actually make money. The hidden business model explained: the bank down the street from you is holding almost none of your actual money.
Not 5%. Not 10%. In many cases, a tiny fraction of what you deposited is sitting in that building at all.
The rest has already been lent out, invested, or moved somewhere else entirely, often within hours of you depositing it.
And here's the part that should genuinely unsettle you. This isn't a scandal. It isn't fraud.
It's completely legal, fully disclosed, and it's the exact business model every major bank on earth is built on. The bank takes your money, quietly turns it into someone else's loan, and pockets the difference. This video is going to show you exactly how that trick works, why it makes banks some of the most profitable companies in history, and why, every few decades, that same trick nearly brings the entire financial system to its knees.
Most people think banks make money by charging fees.
A few dollars here for an overdraft, a small charge there for a wire transfer.
Those fees exist, and they add up. But they're not the real engine. The real engine is something far bigger, far quieter, and honestly, far stranger than most people realize. Here's the simplest way to picture it. Imagine you own a warehouse.
Instead of goods, people bring you money and ask you to store it safely.
But unlike a normal warehouse, you don't have to keep everything you're storing.
You're allowed to take the vast majority of it, lend it out to other people at a higher price, and only keep a small cushion behind, just enough to handle people who show up wanting their stuff back on any given day.
That's essentially what a bank does with your deposit.
When you put $1,000 into a checking account, the bank doesn't lock that $1,000 in a vault with your name on it. It keeps a small portion on hand and lends the rest out to someone else, maybe a small business owner, maybe a family buying a house, maybe another bank entirely.
That borrower pays interest on the loan.
You, meanwhile, are paid a much smaller amount of interest, sometimes barely anything at all, for the privilege of letting the bank use your money in the first place. That gap, the difference between what the bank pays you for your deposit and what it charges someone else to borrow that same money, is called the net interest margin. It's the single most important number in banking, and almost nobody outside the industry has ever heard of it.
Right now, the average savings account in the country pays depositors less than 0.5% a year. Less than 0.5%.
Meanwhile, that same bank might be charging someone 7% on an auto loan, or 20% or more on a credit card balance. The bank borrowed your money for almost nothing and rented it back out to someone else at a massive markup.
You funded the loan. The bank collected the profit sitting in the middle. Picture two neighbors.
One neighbor lets you park your car in their driveway for free, no charge at all. The next morning, that same neighbor turns around and rents your exact parking spot to a stranger for $20 a day.
You never see a cent of that $20. That, in a nutshell, is how a bank treats the money sitting in your checking account. Now, here's where it gets even more interesting, because banks don't just lend out your money once. They lend it out again, and again, and again, in a cycle that sounds almost too strange to be legal. Imagine you deposit $1,000. The bank is required to keep only a small reserve, and lends the rest to someone else. That borrower doesn't keep the cash under a mattress.
They spend it, paying a contractor, or a supplier, or a landlord, and that person deposits the money into their own bank account. Now that second bank has new deposits too, and it repeats the exact same process, keeping a small reserve and lending out the rest again. One original $1,000, moving through this cycle over and over, can end up supporting several times that amount in loans across the entire banking system.
This is called fractional reserve banking, and it's not some obscure loophole.
It's the foundational mechanic underneath the entire modern economy.
Money isn't just sitting still in vaults, waiting.
It's being multiplied, loan by loan, bank by bank, almost like a rumor spreading through a small town, growing bigger and touching more people every time it gets repeated. This is also exactly why banking is one of the most quietly profitable businesses ever devised. A retail store has to buy inventory, mark it up, and hope people actually walk in and buy it.
A bank barely needs to lift a finger once the deposits start flowing in. The money practically multiplies itself, and the bank collects a toll at every single step along the way. But interest isn't the only river feeding this machine. Fees are the second major stream, and they're a lot more aggressive than most people ever notice.
Every time you overdraft an account, pay a late fee on a credit card, get charged for using an out-of-network ATM, or pay an annual fee just for the privilege of holding a card in your wallet, that's pure, almost guaranteed profit for the bank, with none of the risk attached to a loan. Unlike lending, where a borrower might default and the bank could lose money, most fees cost the bank almost nothing to collect. It's closer to finding money on the sidewalk than making a real investment. Then there's an entire category of banking most people never think about at all: the fees hiding inside mortgages. When a bank issues a home loan, it often doesn't keep that loan sitting on its own books for 30 years, quietly collecting interest the slow way. Instead, it frequently bundles that mortgage together with thousands of others and sells the whole package to investors, collecting an upfront fee for originating the loan and another fee for continuing to service it, collecting your monthly payment and passing most of it along to whoever now actually owns the debt. The bank gets paid for creating the loan, gets paid again for managing it, and offloads much of the long-term risk onto someone else entirely. Picture a company that builds houses, but instead of living in the risk of owning them for decades, sells each house the moment it's finished, keeping a small commission, and immediately starts building the next one. That's essentially what large banks do with an enormous portion of the mortgages they issue. Build it, collect a fee, pass along the risk, repeat. So between the interest rate spread, the fees, and the mortgage machine, you'd think banking would be a nearly bulletproof business. And most of the time, it is. Which is exactly what makes the moments it breaks so shocking. Here's the twist most people forget, or never fully understood in the first place. This entire system depends on one fragile assumption, that not everyone asks for their money back at the same time. If only a small percentage of depositors want cash on any given day, the bank's tiny reserve easily covers it, and the rest of the money keeps working, out in the world, earning interest through loans. But if a large number of people suddenly panic and demand their money back all at once, the bank simply doesn't have it. It's already been lent out. This is called a bank run, and it's not some ancient relic from black and white newsreels of the Great Depression. It happened again, dramatically, in 2023. A fast-growing bank, deeply popular among technology startups, had taken enormous deposits during a boom and parked much of that money into long-term government bonds, assets that were considered extremely safe, but that lose value when interest rates rise quickly. When rates did rise sharply, the value of those bonds quietly sank. Word spread fast, largely through social media and group chats among startup founders, and within roughly 48 hours, depositors tried to pull more than $40 billion out of the bank. $40 billion in about a day. Picture a warehouse that confidently promised to store everyone's furniture safely, but had actually shipped 90% of that furniture out to other cities to be rented out for extra income. The moment too many people showed up at once demanding their couches back immediately, the warehouse simply couldn't deliver. Not because the furniture didn't exist somewhere, but because it wasn't sitting there, ready, the way everyone assumed it was. Regulators seized the bank within days. It remains one of the largest bank failures in the country's history, and it happened not because the bank made wildly reckless bets, but because the entire business model, borrow short-term from depositors, lend or invest long-term, is inherently a bit like walking a tightrope. Most days, nobody looks down. Occasionally, everyone looks down at exactly the same moment. This fragility is precisely why banks are watched more closely by regulators than almost any other industry on the planet. After the housing crisis of 2008, when banks had leveraged themselves so aggressively that a wave of mortgage defaults nearly collapsed the entire global financial system, governments forced banks to hold significantly larger cushions of their own capital, specifically so that the tightrope wouldn't feel quite so thin the next time a storm rolled through. Picture a tightrope walker being forced, after one too many near falls, to finally use a slightly thicker rope and a slightly bigger net below. It doesn't eliminate the risk of falling. It just makes catastrophic falls somewhat less likely, and somewhat more survivable when they do happen. So with all of that risk sitting underneath the entire system, why does banking remain one of the most consistently profitable industries in the world, decade after decade, storm after storm? Because the math, when it isn't actively breaking, is simply extraordinary. Consider one of the largest banks in the country, which recently posted $57 billion in profit in a single year, on more than $4 trillion in total assets. Just the spread between what it pays depositors and what it charges borrowers generates tens of billions of dollars annually, before a single overdraft fee or credit card late payment is even counted. Think about the sheer efficiency of that machine for a moment. The bank isn't manufacturing anything. It isn't shipping physical products across oceans. It's essentially charging a toll on the movement of money itself, at a scale most other industries could never dream of touching. This is also why the wealth management side of banking has quietly become one of the most prized businesses inside these giant institutions. Instead of lending money and hoping borrowers pay it back, a bank can simply manage wealthy clients' investments directly, collecting a steady fee on the total assets under management, without taking on nearly as much lending risk at all. It's the same underlying idea as an ETF issuer collecting a tiny toll on trillions of dollars, just wrapped inside a much older, much more heavily regulated institution. So here's what all of this really reveals about banking as a business. It isn't fundamentally about vaults, or buildings, or the little toaster gifts banks used to hand out to attract new customers decades ago. It's about being trusted enough that millions of people willingly hand over their money for almost nothing in return, allowing the bank to quietly multiply that money many times over through loans, mortgages, and fees, and collecting a toll at nearly every single step of that journey. The genius of the model, and the danger buried inside it, come from the exact same source. Banks are only as strong as the public's trust that the money will be there whenever they ask for it. Most days, that trust holds, effortlessly, invisibly, the way a bridge holds steady under normal traffic without anyone thinking twice about the engineering underneath their feet. But every so often, that trust cracks, fast, and when it does, the entire structure can wobble in a matter of hours rather than years. So here's the real lesson sitting underneath your checking account, your savings account, and every loan you've ever taken out. Banking has never really been about safely storing your money. It's about quietly renting it out to someone else, at a markup, while convincing you it was never really going anywhere at all. And here's the question worth sitting with. If the entire system depends on most people never asking for their money back at the same time, is that a brilliant, efficient use of otherwise idle cash, or a quietly fragile bet that just happens to pay off almost all of the time? Do you think banks should be required to hold more of your money in reserve, even if it means smaller profits and higher fees for everyone? Or is the current system, risk and all, simply the price we pay for a financial system that actually works? Let me know in the comments.